For the last 3 years, SCHD investors have had to exercise a particular kind of patience. While the S&P 500 and the Nasdaq roared higher, powered by a handful of technology giants, SCHD quietly paid its dividends, grew its distributions, and delivered solid but unspectacular price returns. The gap between SCHD and VOO during this stretch was wide enough that plenty of investors started questioning whether the dividend quality approach was still relevant in a world where Nvidia could return 200% in a single year. The comparisons were everywhere. The doubts were real. And SCHD investors who checked their account values against the S&P 500 during 2023 and 2024 had to do a lot of convincing themselves that the strategy still made sense. But there is a name on Wall Street who has been paying very close attention to exactly the sectors that SCHD is built from, a name with a track record of calling major market rotations before they become obvious to everyone else. And in early 2026, that name, Tom Lee of Fundstrat, is making some of the most explicitly SCHD-aligned macro calls of his career. He is not talking about SCHD directly. He does not have to. But when you line up what Tom Lee is saying about which sectors he expects to lead in 2026, and then you look at what SCHD actually owns, the overlap is striking enough that SCHD investors should be paying very close attention. In this video, I am going to break down Tom Lee's 2026 sector thesis in detail, what he is bullish on, why, and what the macro case behind each call actually is. Then I am going to map each of those calls directly to SCHD's composition and show you exactly where the overlap sits and how significant it is. I will cover the February 2026 rebalance of his GRNY ETF, which just added stocks that are core SCHD holdings and made sector allocation moves that mirror SCHD's own positioning almost exactly. And then I will give you the honest conversation that every SCHD investor needs to have right now, including the warning that even a legitimately bullish macro thesis does not mean you should pile into any single fund at any price. Let me start with Tom Lee himself, because understanding who he is and how he builds his views is essential context for evaluating why his current positioning matters. Tom Lee is the co-founder and head of research at Fundstrat Global Advisors, an independent market research firm that advises institutional and sophisticated retail investors on macro strategy and sector positioning. Before Fundstrat, Lee spent years as J.P. Morgan Chase's chief U.S. equity strategist, one of the most closely watched research roles on Wall Street, where he was consistently ranked among the top equity strategists in the industry by institutional investor surveys. His track record spans more than 25 years of navigating market cycles from the tech bubble of the late 1990s through the financial crisis, the COVID crash, and the 2022 bear market. What distinguishes Lee from many commentators is not simply that he is often bullish, plenty of people are permanently bullish, but that he has demonstrated a specific ability to identify sector rotations before they become consensus. In 2025, when many strategists were still cautious about equity markets following the rate shock of 2022 and 2023, Lee stayed persistently bullish, and his S&P 500 price targets proved remarkably accurate. He correctly called the energy sector's rotation into favor during a period when most attention was still laser-focused on AI and semiconductors. His call that technology stocks would hand the baton to energy, financials, and basic materials in 2026 was made before the rotation became visible in price action, which is the exact kind of early identification that his reputation is built on. Lee's views also carry institutional weight. Fundstrat's research is distributed to portfolio managers, family offices, and institutional investors who move significant capital. When Lee shifts his sector allocations, the people reading his research are the kind of investors whose subsequent positioning moves prices. That creates a reflexive dynamic. Lee identifies a trend. Institutions follow the research. Their buying accelerates the trend, and the original thesis becomes self-reinforcing. This does not mean his calls are guaranteed to be correct. No one's are. But it means that the mechanism connecting his research to market outcomes is more direct than commentary from less followed analysts. When Tom Lee is bullish on a sector, it is worth examining whether you own that sector and whether you own enough of it. Now let us get into the substance of what Lee is actually saying about 2026, because this is where the SCHD connection becomes concrete. Lee's S&P 500 year-end price target for 2026 is 7,700, approximately a 10% gain from the beginning of the year. He is forecasting a fourth consecutive year of positive equity market returns, driven by three primary macro tailwinds. The first is a more accommodative Federal Reserve. Lee believes the Fed will cut rates in 2026 as inflation continues its descent toward the 2% target, and that the bond market is already pricing in more cuts than the Fed has officially indicated. Falling rates lower the discount rate used to value future earnings, which is mechanically positive for equities, and particularly positive for the value-oriented and dividend-paying companies that make up SCHD's portfolio. The second tailwind is the end of the Federal Reserve's quantitative tightening program. QT, the deliberate shrinking of the Fed's balance sheet, has been a quiet but persistent headwind for financial markets since 2022. Lee draws a historical parallel to September 2019, when the cessation of a prior QT cycle coincided with a meaningful market rally. The removal of this headwind improves liquidity conditions across financial markets, which tends to benefit the kind of quality cyclical companies that Lee favors and that dominate SCHD's holdings. The third tailwind is broader earnings expansion beyond the technology megacaps. Lee argues that 3 years of equity returns, driven primarily by a handful of AI-exposed technology companies, has left a large portion of the market, including energy, industrials, financials, and consumer businesses, trading at valuations that do not reflect their earnings quality or their position in the current economic cycle. As capital broadens out from technology into these underappreciated sectors, the funds that own them most heavily stand to benefit disproportionately. And here is the critical point. The sectors Lee is calling out as his top picks for 2026 are not abstract thematic calls. They are SCHD's actual portfolio. Energy and basic materials are Lee's #1 sector pick for 2026. In a January 2026 appearance, he stated explicitly that his top sector call is energy and basic materials, sectors he believes could outperform technology in 2026 after years of underperformance. He has gone further, calling energy a potential decade-long investment theme, not a cyclical trade. Industrials are Lee's second major focus, a sector he sees benefiting from infrastructure spending, lower borrowing costs, and the broader capital expenditure cycle that AI and electrification are driving. Financial sector large caps and regional banks round out his top 3 sector themes, with M&A revival and deregulation tailwinds providing specific catalysts for bank earnings and investment banking revenues. Now let me show you why this matters so specifically for SCHD rather than for the S&P 500 as a whole. VOO, which tracks the S&P 500, has approximately 30 to 35% of its portfolio in technology. Energy, materials, industrials, and financials together represent roughly 25 to 30% of VOO. If Lee's sector rotation thesis plays out and technology underperforms, while energy, industrials, financials, and materials lead, VOO gets a mixed outcome. Its technology holdings are a drag, its other sectors help, and the net result depends on the magnitude of the rotation. SCHD's sector composition is essentially the mirror image of VOO's. SCHD's top sectors as of early 2026 are energy at approximately 17 to 19%, financials at approximately 17 to 18%, industrials at approximately 14 to 16%, and consumer staples at approximately 12 to 14%. Technology represents roughly 8% of SCHD. If Lee's rotation plays out, SCHD does not get a mixed outcome. It gets an almost entirely positive one, because the sectors Lee is most bullish on represent the overwhelming majority of what SCHD owns. The most concrete, data-specific evidence connecting Tom Lee's current positioning to SCHD comes from the February 2026 quarterly rebalance of his Gurney ETF, the FundStrat Granny Shots US Large Cap ETF. GRNY is the vehicle through which Lee translates his FundStrat research directly into a live, investable portfolio. It has grown to more than $4.1 billion in assets under management since its November 2024 launch, making it one of the fastest-growing actively managed large-cap ETF launches in recent history. When Lee rebalances GRNY, he is not expressing an opinion for a podcast. He is allocating real institutional capital to his actual convictions. The February 2026 GRNY rebalance tells a clear story. Following the rebalance, the largest sector allocations in GRNY are information technology at 25%, industrials at 20%, financials at 15%, energy at 8%, communication services at 7%, and materials at 7%. That means industrials, financials, energy, and materials together account for 50% of GRNY's portfolio after the rebalance. Those are the exact four sectors that dominate SCHD's composition. Lee also shifted Journey's investment style tilt from growth quality to value quality plus quality cyclicals, a deliberate move away from the high-growth technology positioning that characterized the 2023 and 2024 market leadership and toward the kind of value and cyclical characteristics that SCHD has been built around since its inception. The stock additions in the February 2026 GRNY rebalance make the overlap even more explicit. The new positions added include Amgen, Chevron, Northrop Grumman, Union Pacific, Air Products and Chemicals, ONE-OK, Packaging Corp of America, PPG Industries, and Texas Pacific Land. Amgen and Chevron are not just companies that happen to share sectors with SCHD. They are direct top holdings within SCHD's portfolio. Chevron is one of SCHD's largest energy positions. Amgen is one of SCHD's most significant healthcare holdings. The fact that Lee is buying the specific stocks that SCHD already owns, not just the sectors, through his own actively managed fund, is about as direct an endorsement of SCHD's portfolio construction as you could ask for from an investor of his caliber. He did not pick those stocks because they are in SCHD. He picked them because his Granny Shots thematic framework identified them as being at the intersection of multiple structural tailwinds. SCHD's screening process, which selects for dividend consistency, return on equity, cash flow strength, and 5-year dividend growth, independently arrived at the same conclusions through an entirely different methodology. Two different research approaches, the same names. Let me now give you the honest conversation that I promised at the beginning, because no bullish macro thesis, regardless of who is making it, is a reason to make sloppy investment decisions. The fact that Tom Lee is bullish on SCHD's sectors does not mean SCHD will definitely outperform VOO in 2026. It does not mean SCHD is a buy at any price. And it does not mean the rotation he is predicting will happen on the schedule he anticipates. There are real risks here that deserve to be named clearly. The first risk is valuation and entry price. After a period of relative outperformance versus VOO in late 2025 and early 2026, SCHD has moved meaningfully from the $25 to $26 range where it spent most of 2024 to the $30 to $31 range. Investors who bought at the bottom of that range during SCHD's underperformance period are sitting on solid unrealized gains. Investors who are considering entering a new position today at $30 to $31 are doing so after a significant move has already occurred. Craig, a long-term SCHD investor who holds a substantial position, made exactly this point in a recent conversation. Some of the easiest money in SCHD has already been made, and buyers at current prices need to be realistic that a 10 to 15% near-term pullback is entirely plausible even if the long-term thesis remains intact. The investors who have been dollar-cost averaging into SCHD for years should continue doing exactly that. The investors who are considering a large new position at current prices, hoping for another immediate 14% gain, need to be more careful. The second risk is that sector rotation calls, even from well-credentialed analysts, do not always materialize on the predicted timeline or to the predicted magnitude. Tom Lee has an excellent track record, but he is not infallible, and his 2026 thesis includes a significant dose of uncertainty. He himself has acknowledged that 2026 will be a year of what he describes as joy, depression, and rally, meaning meaningful volatility and potentially a significant correction in the middle of the year before the year-end target is achieved. A 10 to 15% correction in the broader market during 2026 would likely affect SCHD meaningfully, even if its sectors hold up better than technology-heavy funds. Investors who buy SCHD at current levels need to be prepared for that scenario emotionally and financially. The third risk is the one that catches most investors off guard: recency bias in reverse. Just as it was a mistake to pile into SCHD in late 2024 when it first hit all-time highs because you were extrapolating recent outperformance forward, it would be a symmetric mistake to dramatically underweight growth and technology funds right now because they have underperformed recently. The same funds, QQQM, VGT, VOO, that are currently lagging SCHD by a wide margin are now at significantly more attractive valuations than they were a year ago. A balanced investor thinking clearly about 2026 should be asking not just whether to own SCHD. The answer to that question is almost certainly yes for income and dividend growth investors, but whether this is the moment to pair SCHD with a meaningful allocation to the growth names that are currently on sale, rather than concentrating even more heavily into the fund that has already had its run. The long-term case for SCHD remains as strong as it has ever been. Investors in the fund who hold for 5, 10, or 20 years and reinvest every dividend are building one of the most powerful income compounding machines available in the ETF market. The dividend growth rate of approximately 10 to 11% per year, sustained over decades, turns a modest initial yield into an extraordinary income stream relative to the original investment. The 10-year consensus among long-term SCHD investors projects approximately 8 to 10% annual total return going forward, with 3.5 to 3.7% in current yield and mid to high single-digit price appreciation as the components. That long-term return is not dependent on Tom Lee's 2026 sector calls being correct. It is dependent on SCHD's underlying companies continuing to be quality businesses that grow their earnings and dividends, which the fund's rigorous screening process is specifically designed to ensure. What Tom Lee's research does is add a short to medium-term tailwind argument on top of the long-term structural case. If his sector calls are right, SCHD gets a year or two of above-average price appreciation in addition to its regular dividend compounding. If they are not right, if technology continues to lead and the rotation does not materialize as expected, SCHD's long-term income investors are not harmed. They collect their dividends, reinvest them, and wait for the cycle to eventually turn in their favor. The long-term thesis does not depend on the short-term call being correct. The short-term call is a bonus, not a requirement. The bottom line for SCHD investors is this: the macro environment described by one of Wall Street's most respected strategists is unusually well aligned with what SCHD owns right now. The February 2026 GRNE rebalance shows Lee putting real money into the specific stocks SCHD already holds. His explicit pivot from growth quality to value quality in his own ETF mirrors SCHD's fundamental investment philosophy. And the sectors he is calling as his top picks for 2026, energy, industrials, financials, materials, account for the majority of SCHD's portfolio. That alignment is meaningful and worth understanding. It is not a reason to abandon diversification, over-concentrate into SCHD, or chase recent performance. It is a reason to feel confident about the long-term positioning of a fund that has spent 3 years quietly compounding its dividend while waiting for exactly the kind of market rotation that may finally be arriving. If this breakdown helped you think more clearly about SCHD's positioning and Tom Lee's current macro thesis, hit the like button and subscribe. I release new content on dividend ETFs, portfolio strategy, and income investing regularly. Drop a comment below with your current SCHD position and your thinking on the rotation. I read every comment, and these conversations help everyone on the channel. I will see you in the next one.